Let me start by welcoming everybody for this session, which is termed Roundtable on Monetary Policy Reforms for Sri Lanka with learnings from New Zealand. Thank you, Governor Weerasinghe, for enabling this session, and for everybody who is attending. One might be wondering the configuration of the room, that the central bank people on one side of the room and the invited guests are on the other side. So this is not us against you all. It's just that it's just an issue of protocol. But hopefully this will be a common learning for all of us. And let's keep it lively. We can make it as interactive as possible. We decided, first of all, there was an offer from the High Commission of New Zealand to share some of their learnings leading up to this crisis. As you know, New Zealand is a very small country with about 5 million people. We all know them for rugby. They are by far the best team in the world from the history of the sport. But in many sports, they punch way above their weight class. And in economic sphere also, they have done a lot of innovative things. And I believe that it was the first country to use inflation targeting. There's a lot of trade reforms, so there's a lot of things that we can learn of them. And all of this was precipitated because they also went through an unprecedented financial crisis once in 1975. After the UK joined the common market, they also had a fixed exchange rate, and there was a large depreciation in the currency. And thereafter, in the 1980s, they did a lot of reform. Professor Spencer, who was a former deputy governor of the central bank, will share some of these learnings. So if I can first start off the session by asking High Commissioner, His Excellency Michael Appleton, to make his opening remarks and thereafter introduce Professor Spencer to the audience.
Thanks very much, Murtaza. It is an absolute honour to be here, and I'm really humbled that all of you are taking the time to hear about the New Zealand experience and how it might apply to Sri Lanka's current situation. Before I start, I just wanted to say a few thanks. One to Advocata, obviously, Murtaza here, but done enough as well, who's the engine room of the organisation. I think you should be proud of the way that you have influenced public discourse on Sri Lanka's crisis and reform paths ahead over the past week or so, and we're pleased to be playing a small part in that. I also wanted to thank the central bank and especially the governor for taking part in this event and for being interested again in New Zealand's experience. I just wanted to say how impressed I've been since the governor has taken over in his openness and transparency about Sri Lanka's situation and keenness to find the right solutions to Sri Lanka's problems, transparency being one of the very important components of Sri Lanka's response, and convincing both the Sri Lankan people and the international community that there is a plan being put in place to take Sri Lanka from where it is to where it needs to be. So I really just want to commend the central bank and the leadership, under the leadership of the governor, for the role that it's playing in that. I also want to thank Grant through the video for taking part in this. It's one thing to say that New Zealand wants to contribute expertise to Sri Lanka's situation. It's another to find an expert who is able and willing to talk with authority on that experience. So I'm very grateful for his willingness to take part. Now, a lot of you may be thinking that this is a sort of a somewhat odd situation. Why would New Zealand care about monetary policy in Sri Lanka, or about the range of other technical policy decisions that you're having to take in the period ahead? There are a few reasons that we care. We New Zealand are a new High Commission to Sri Lanka. We got here a year ago. I got here about a year ago as New Zealand's first High Commissioner to Sri Lanka, and I must say that my first year here is not at all what I expected my first year to have been like. But as I have watched the economic crisis unfold, it has struck me that a range of the issues that Sri Lanka is facing in terms of economic reform are issues that New Zealand has, in our own way, gone through in the past few decades as we have faced various economic crises and we have had to come up with innovative policy solutions. So I'm strongly of the view, and this is a view that I've expressed to the President, to the Prime Minister, to various other political leaders, that New Zealand will have some expertise in some of the issues you're facing, certainly not all of them, but some of the issues that you're facing. And where we do have that expertise, we would like to help you as you go through this toughest of times and offer our reflections on our own history, some of which will be relevant, some of which won't, so that you can apply that which is relevant. I suppose one final observation I'd like to make before introducing our main speaker is that the consideration of monetary policy or any technical policy issue needs to be viewed in a much broader context. And I think all of the people who have analysed how Sri Lanka got itself into the situation it did would talk about causes, some of which are essentially economic, but others which are essentially governance and related to Sri Lanka's governance. And I think it's true of New Zealand's response to our problems that many of our responses actually were not just related to our monetary and economic policy settings, they were also related to how we run our country. And I think some of Sri Lankan's politicians, including the President, have reflected on that. But good governance is a core part of New Zealand's success story, and I think it will need to be a core part of Sri Lanka's economic recovery story if it is to be successful, and I obviously hope that it can be. So with those brief remarks, I just wanted to introduce formally to everyone this gentleman here who's sitting in, it looks like his home in Wellington, my home city. Grant has a long experience in central banking, but also in the private sector as well. He was in, if I'm not mistaken, he was in the bowels of the Reserve Bank when New Zealand went through its greatest economic shocks in the 1970s and 1980s. So he comes to these questions with great authority. And then he recently retired from the Reserve Bank after a period of being its acting governor. So I'm very pleased and proud that Grant is able to speak to you all of New Zealand's experience on monetary policy reform. And I'm really looking forward to what he has to say. Thanks so much, Grant, for being with us.
Well, thank you, Michael, for that introduction, and good morning, everyone. I hope the link is working satisfactorily. Someone should sort of wave their hand if you want me to pause for a bit. But as Michael said, my task this morning is to talk about the monetary reforms of 1984 to 1990 that occurred in New Zealand. As you know, today, New Zealand is an open, well-developed, market-based economy. But back in the 70s and early 80s, it was a much more controlled economy. And we had a set of circumstances in the early 80s that culminated in some major economic reforms. And those circumstances were really some pretty adverse external shocks, with the second oil shock of 1979 and then sort of a global recession through the early 80s. A lot of that associated with sharp increases in interest rates as Paul Volcker and others were grappling to get inflation down in the major economies. So we had demand for exports falling, export prices falling, a very negative external outlook. But the government at the time was trying to use controls to try and protect the income and employment levels within the economy. and they became increasingly untenable, and major imbalances started to emerge with large fiscal deficits, a large balance of payments deficit, high inflation, an overvalued exchange rate. And ultimately, this led to a change of government. There was a foreign exchange crisis, essentially ran out of reserves, 20% devaluation. And as I say, the government changed, and the new government really had quite a clear mandate to reform the economy. And so broad-based reforms were put in place over the following years in the private sector, the real markets, labour market, trade, as well as the financial sector, monetary policy, fiscal policy, and public sector governance. So it was a very broad set of reforms, and this morning I will focus on the monetary reforms that took place, but there is that broader context. Now, in terms of the monetary reforms, I would say there are three main key elements. The first was a new governance model for monetary policy, where the central bank was given a single clear objective of price stability and given the independence to get on with the job and achieve that objective. And, you know, that sounds fairly conventional today, but in the early 80s, it was very different. It was the Minister of Finance really was controlling monetary policy decisions. So this shift to give that decision-making power to the central bank was very different for New Zealand at the time. And I'll come back to that change in the governance model. But the second key element was the floating of the New Zealand dollar. And if we go back to Mundell's trilemma, which I mentioned in the note that I circulated, the trilemma essentially says that if you have open capital markets, then a country can either choose to control its domestic interest rates or the exchange rate, but it can't do both. So given that New Zealand was really dependent on foreign capital and we needed to have an open capital account, we had to make the choice between continuing to manage a currency or really having effective control over domestic monetary policy, and we chose the latter. So we got on and moved towards floating the New Zealand dollar, which happened in March of 1985. And ahead of that, we removed the remaining exchange controls, and we set up the commercial banks to be able to act effectively to run the foreign exchange market, you know, in the private sector rather than in the official sector. So that was the second key element. The third key element was financial deregulation, the deregulation of the banks effectively. Because through the 70s and early 80s, the government and central bank had used price and quantitative restrictions to try and control credit through the banks. That had been the norm for monetary policy. And that had caused a significant disintermediation of funds to flow. In other words, funds were flowing outside of the banking system through the non-banks, and the banks themselves were becoming less and less important in the overall financial intermediation in the economy. So if we wanted to move back to a a market-based allocation of credit, and a banking system that would facilitate a market-based monetary policy. And so we had to remove a lot of those restrictions, interest rate controls, government security ratios, credit controls, all sorts of things. They were all removed from the banks in order to prepare the way for a market-based monetary policy and a market-based credit allocation framework. So in addition then to the change in the governance model at the Reserve Bank, floating of the currency and financial deregulation were very important. But if I come back now to the governance model, the central bank with operational independence, I just make a few points. And firstly, I would say that this idea of sort of devolving decision-making power from the minister down to the governor was replicated in other parts of the public sector. So in other words, it was a broad principle that was adopted by the new government at the time, that ministers should make less operational decisions. They should make high-level decisions, strategic decisions, push the operating decisions down to chief executives of SOEs, of government departments, etc. But give them very clear objectives and give them clear operating guidelines and make them accountable. So that was the broad principle that really effectively gave rise to the inflation targeting model, which then subsequently we put into legislation in 1989 and was subsequently adopted by many central banks around the world. The second point I would make around the governance model is the role of Treasury in decision-making, because we removed Treasury officials from the Reserve Bank Board and from the Monetary Policy Committee. And so rather than Treasury being involved in monetary policy decisions, Treasury was set up as the monitor. In other words, the agent of the minister to monitor the performance of the central bank. And if you're going to have an effective monitor, if Treasury is going to be an effective monitor on behalf of the minister, the Treasury can't be involved in the decisions themselves because they can't be monitoring their own performance. So we felt this was an important aspect of the new governance model, is to take Treasury off the central bank board and policy-making committees. I would say the exception there, or this was for monetary policy. When it came to financial stability policy, financial regulations, Treasury continued to have a joint role with the Reserve Bank. So my comments there relate to monetary policy. Now, I mentioned accountability structures are very important. If you're going to give the central bank more autonomy and objective and operational independence, then they need to be accountable. So accountability structures were set up. The bank remained effectively accountable to the minister through the minister's appointment, power to appoint the governor, to appoint board members, to appoint MPC members. The minister would set the remit in terms of the sort of operational guidelines for monetary policy. And the minister, in our case in New Zealand, also signs off the 5-year budgets for the central bank. So it was moved from a sort of we didn't want to continue with annual budgets, but so it's more a 5-year budget. So there's not the temptation to control the purse strings year to year, but so that it's a long-term budget, but the minister still needs to sign that off. Now, the central bank also needs to be accountable to the public and the markets. And so there's a requirement for the bank and encouragement the bank to communicate actively, to produce regular reports on its policy making, to provide policy analysis, the reasons for its decisions and analysis of its previous decisions, have regular press conferences, etc. So that accountability to the markets and public as well as the minister was important. In our case, we also require accountability to Parliament, that reports from the bank must be tabled in Parliament, and the governor must front up to parliamentary committees for sort of cross-examination. Now, another important aspect to support operational independence is financial independence. So the central bank, in order to be fully independent and to implement policy to achieve that price stability objective, needs to have control over its own balance sheet. And that was certainly not the case in the early 1980s when we were getting these reforms underway. So the changes involved stopping central bank lending to SOEs and to government agencies that had been occurring before that. The government was required to fund its fiscal deficits in the market rather than directly from the central bank, so that any central bank purchases of government securities would be at the discretion of the bank, not at the discretion of the minister or Treasury. We also needed to remove some agency functions that had been present in the central bank that presented potential conflicts. For example, the Reserve Bank had managed the government debt program, run the tenders, etc. So that was sort of handed back to the Treasury in a new structure called the Debt Management Office that was set up within Treasury. The Reserve Bank did retain management of the foreign reserves, which does not present conflict. It was not involved in any management of domestic assets for the government or the private sector, which would potentially generate a conflict. And as I mentioned before, the bank continued to run the financial regulation and banking supervision, which I believe, have those two functions of price stability and financial stability have very good positive synergies when those two functions are run within the same institution. And they also provide a sort of a critical mass for a central bank in a small country situation. One other aspect I would mention is the sequencing of reforms. So at the time of the reform, there was a lot of debate around sequencing, and the sort of academic argument was that we should deregulate the real sector of the economy before tackling the financial sector. But the reality was that it was the other way around, because financial deregulation was more immediate and more sort of easier in terms of being able to implement that rapidly. So there were clearly some distortions as a result, because you can't deregulate everything at the same time. But I would say that the financial deregulation gave considerable impetus and momentum to the broader reform program. So finally, in terms of the results of the reforms, they did succeed in getting inflation down to the 0 to 2% target that we had at the time in 1991. That, so the target was adopted in the mid-80s, so it took 5 or 6 years to get it down from over 10% down to that 0 to 2%. And New Zealand was moved from really a controlled economy to a market-based economy. But there was certainly a lot of cost, volatility, and pain in that transition period. It was not an easy period from an economic or political perspective. And there were particular sectors, I would say in particular the exposed sectors, export sector, were hit pretty hard. And you know, that you have to manage it as well as you can, but inevitably in that sort of transition where resources are shifting between sectors, there's going to be some pain. Now, in the years since, of course, governments have changed a number of policies in the labour market, financial regulation, different areas. But the monetary reforms that were put in place at that time do largely remain in place today and continue to provide an effective nominal anchor for the New Zealand economy. So I will leave it there, Chair, and hand it back to you. Thank you.
Professor Spencer, if I can now ask the next speaker on the agenda, Dr. Sarath Rajapatirana, who is the chair of the Advocata academic program, who also happened to have been a central banker here many years ago, to make his comments. You can press the button.
Right. I feel quite at home here, although I left the place in 1975 after 10 years. So this was my alpha mater after the university. It's a good place to work for. I think still it is, yeah. I want to just say the presentation was quite parallel to what we have, in the sense that not in the extreme. I mean, New Zealand didn't have the tremendous debt problem that we are having, and number one, and also access to the funds were available still, I think, at that time. And it's an easy place in a way. Then our politics were, yeah, right. Thank you. Our politics also came into play. So there was a big, what is the word, admixture of politics and economics, which is not always very helpful. Although there are a lot of politics involved in decision making, but the setup was that we can't really decide whether which came first, type of chicken and egg question. So we have similar challenges. I think the central bank has a very important role to play, as always. And we depend on it for stability, as we have indicated, which is a very big challenge at the moment. And so I learned a lot when I read the piece, and thank you very much for it. And I saw the parallel, but on the other hand, our system is, what do you say, more delicate, more difficult to overcome, unless we work at it very clearly, and the timing and sequence is very important. Also, the real sector issues are important. After all, at the end of the day, we want real GDP to go up, which means investment to go up, FDI to go up. All these things must be planned and done well, and a lot of working together with the Ministry of Finance and the Central Bank. And we have been arguing for central bank independence at various fora for the last 5-6 years. And then the question is to ask, what type of independence do you have? In a way, I would call what the New Zealand system at the beginning sounded to me like what I call bounded independence. And that may not be a bad thing for us to have. Ministry of Finance comes at certain defined ways, can intervene. So if you feel that there's an important challenge to the economy, then the Ministry of Finance can not control, but work together on this issue, but otherwise have independence, and use the term operational independence. So that would be very helpful to us. So those are my comments. Thank you very much.
Thank you, Dr. Rajapatirana. Next is to you, Governor. Would you like to make some comments?
Thank you. First of all, let me thank Advocata for organizing this very important seminar, and also I was delighted to host it when Murtaza told me that Grant Spencer is coming to share his experiences. And also I'll thank Your Excellency Michael Appleton for supporting and arranging this seminar. I think this, in terms of what was discussed and presented by former Deputy Governor Grant, I think it's quite basically enlightening the way that obviously at the Reserve Bank of New Zealand is based in our process. We have studied a lot as a pioneer central bank which implemented central inflation targeting regime, and in our reforms for last, as central bank for last 30 years, myself and our staff, especially monetary policy staff involved in monetary policy, basically have been studying the New Zealand's experience quite closely, and we in fact learned a lot of lessons in our process. This is where I just would like to share Sri Lanka experience a little bit, just to give you an idea. In fact, we were basically moving towards what we call inflation targeting regime for monetary policy implementation since, I think, as far back as 2008-9, where we had a very high inflation episode, about 28% in 2008. And since then, what we have been doing, trying to implement and implement the key features of inflation targeting regime in our monetary policy framework. But what happened basically, we were seeing the success to a certain extent in terms of when you compare inflation before 2008, on average 12%, and next 12 years we had about average 5%, which is our target between 4 to 6%. We have been able to manage, but despite a lot of challenges, what we failed basically, although we were basically practicing and using key features of inflation targeting regime under the interest rate targeting and the flexible exchange rate regime, but still we were not able to formalize the inflation targeting regime in our central banking law, which basically was drafted back in 2019. It's about to be passed in the Parliament. This bill had key features of what you just explained here in terms of central bank independence, the accountability, and all key features. Basically, I can remember when Grant was explaining the process, I think we clearly recognize, and not only that feature, but also the latest development in inflation targeting regime, which we call flexible inflation targeting regime, sometime later adopted by some other central banks. Recently, especially with frontier markets, central banks that we have studied. So I think it's quite useful to learn what the governance, accountability structure, and one of the, as I said, what we were not able to implement is to get it formally approved, the central banking bill, and also one of the challenges What we did not have, because we did not pass a bill, was the central bank independence was not formally basically recognized in the law. As a result, we had on the one hand, my question again, I like your views on the, at the time the Central Bank of New Zealand basically implement this law, still we had the challenge of very large fiscal deficit imbalances. Even all the years that we had inflation maintained around 4-5%, but still we had the government running fiscal deficits about 8-9%, and very high both domestic and external debt. That obviously was a huge challenge for the central bank to maintain maintain a proper inflation targeting regime while the government is running large fiscal deficits, and also political influence to the central bank operations, because law had certain provisions that central bank had to monetize part of the fiscal deficits. And also part of the operational independence, policy independence was there, but in the appointment process were not quite independent. As a result, there were several changes, political influences for the central bank decision, especially coming from fiscal dominance as a result of very large fiscal deficits and the large government debt, and also part of the conflict of interest, as you mentioned, the central bank responsibility as the debt management function is part of the agency function of the central bank, which had obviously a conflict between the key objectives of the central bank versus the agency function. Those are things that we were basically planning to address through a new law, and this is now we are in the process of revamping this operation and getting new law passed by the parliament under the IMF program, and also as well as a plan to have independent debt office, so that we take out the agency function, which has obviously conflict. So my finally, I think I also seen the financial stability component of the Reserve Bank initially, which is quite similar to what we do here. More than that, there's a strong monitoring process by the Minister of Finance, I think, in their provisions. So my question to you is, what kind of fiscal policy, whether it was supplementary or complementary, or whether it's basically conflicting, at the time the Reserve Bank of New Zealand implementing these reforms, and whether you had any kind of conflict? And obviously I can see new law had this conflict, but what is the impact, if there is any, in terms of fiscal policy? Obviously, or macro policy coordination is quite important. Both monetary and fiscal policy coordination is what we have incorporated in our new law as well. And second one, I mean, this is one comment I would like to see your comments, because we have very basically kind of experience that fiscal policy, fiscal domains always have an impact, and the new law would certainly try to address that part. But still, if the government continues to run fiscal imbalances, and as a result there are large current accounts, external current account deficits and balance of payment pressures, and then how would the central bank operational and policy independence basically would, what kind of challenges, if you had any experience? I would like to have your comments. Thank you very much. I'll stop here. I'm happy to have a discussion. I also allow others to ask questions. Thank you.
Thank you. Before we go to others, perhaps it would be best, Professor Spencer, if you answer the governor's two questions, which I think has been clear to you.
Yes, the fiscal situation, as the governor says, is crucial for the success of monetary policy to achieve its objective. I mean, in the early 80s, or when the reforms were taking place that I was talking about, the fiscal deficit was quite large, but probably not as large as you were talking about, which is like 8 to 9% of GDP. I think it was more in the order of, 5 or 6% of GDP. And then during the latter part of the 80s, the government moved to reduce the fiscal deficit. So fiscal policy was working in the same direction, if you like, as monetary policy. They're both sort of consolidating. and there were significant fiscal reforms as well as the monetary reforms. So in some ways, that helped to make monetary policy effective, but it also had quite a contractionary effect on the economy at that time. Now, I think the second part of the governor's question is, can the central bank still achieve its objective if the government continues to run large fiscal deficits? And I would say, well, it probably can achieve it, but it becomes more costly and more difficult, a more difficult problem. And because if the government is taking all the savings in the economy as well as external savings, then as he said, they're going to be running a large fiscal deficit. You're probably going to have a current account deficit. You're going to have a situation where probably the exchange rate might be declining, but interest rates increasing more than they would otherwise increase if the fiscal situation was under more control. So there's no doubt about it that you can have an independent central bank, but if the fiscal situation is not under control, it's going to make the job very difficult.
Thank you, Professor Spencer, for those clarifications. For once, we are running ahead of time. So if I can ask Dr. Roshan Pereira, who was also a former central banker, whether she wants to make any comments or ask any questions.
Thank you. I just have a question. I think they're all related. Basically, you ended your presentation by talking about Reserve Bank of New Zealand in an inflation targeting framework. But I think in 2019 you sort of changed the framework, and you've moved to a more sort of a flexible inflation targeting framework. So my question is really, how was that process how did you come about that process to revise the mandate of the central bank from pure inflation targeting to this flexible inflation targeting? And related to that is basically, I think also there's a process by which the government, you said the government basically sets the mandate really, or it's not the mandate, the objectives in terms of economic objectives. And I think there too you have sort of included certain objectives relating to, I think earlier it was to do with sort of the welfare of the economy, relating to sort of exports, creating jobs and high wages, reducing inequality and poverty, but that was also amended to include the housing sector at a particular point in time to ensure financial stability. So the second question is, how did you sort of come about that process to include a broader mandate? And the third question is really in terms of, you have a public consultation process, I think, to revise the mandate of the central bank's mandate sort of every 5 years. How does that process take place, and what has been your experience? How has it helped to sort of refine the mandate of the central bank, or the monetary policy framework of the central bank? Thank you.
Well, thanks for that question. That quite a broad question, very relevant to the implementation of monetary policy. The first point I would talk about is this flexible inflation targeting, because the change in 2019 that you mentioned is a shift from the single price stability objective to two objectives, or the dual mandate of price stability and maximum sustainable employment. And that dual mandate, as you know, is what the Federal Reserve has, many central banks around the world have that dual mandate. But that is different, in my view, to flexible inflation targeting, because right from the beginning in New Zealand, when we just had a single objective of price stability, it was still, we called that flexible inflation targeting. Because what that meant is that we're not trying to achieve price stability every quarter or every year. You know, we have now the inflation target is 1 to 3% with a 2% midpoint. So you're aiming on average over the medium term to be inside the target range with a preference to be in the middle of that target range. But from time to time, you're going to be outside of that range. And it may be quite sensible to be outside of that range. For example, when you have a big oil shock, for example, then you know you're not going to try and offset that initial price shock from an increase in the price of fuels. Sometimes you just have to let that blip flow through, and you move outside of the price stability target for a period before moving in the medium term to get back, make sure you're back inside the range. That's what I call flexible inflation targeting. It's the medium term perspective on the inflation target. The other issue is just whether you have a single price stability objective or the dual mandate of price stability and employment, maximum sustainable employment. Now, the reason that changed in New Zealand in 2019 was there was a change of government, and the government's election, the new government, the current Labour government, the minister had this preference to change monetary policy to introduce the dual mandate. Now, so and that happened. That was a political decision. It was, you know, in the election platform of the Labour Party before they came to government, and they introduced it. There was no consultation as such. It was just a political act. But you know, the question you have to ask is, well, has it really changed monetary policy? And I'm not sure it really has. I mean, you know, you can debate this for hours, and whether it really makes a difference whether you have a dual mandate or a single mandate. It's probably more important, you know, the governor and the approach and discipline in the central bank. Now, my preference would be to have the single mandate, the price stability mandate. If you're going to have two, the dual mandate of maximum sustainable employment and price stability, I think the price stability should have a priority over the employment objective. And that is the case in the Bank of England, for example, where they say, you know, maximum sustainable employment subject to achieving the price stability target. In other words, it's really saying that you're never going to be able to achieve maximum sustainable employment if you don't have inflation under control. So inflation, price stability for monetary policy still has primacy, in my view, even under the dual mandate. But, you know, you will find different people argue, you know, one way or the other. I think I would not have changed from the single price stability objective to the dual mandate because, you know, when you're operating monetary policy, you have price stability as the objective, but you're always having regard to employment, having regard to volatility in output, and you're not going to chase price stability and cause damage to employment unless it is really necessary to achieve your medium-term objective. So the remit and the legislation makes it clear that you have to have regard, and obviously you have to have regard to what's happening in the economy. Anyone can to just achieve price stability with having no regard to the real economy is a simple task, but it's not a realistic objective. And so the remit and the legislation say you have to have regard to employment, volatility, and also financial system stability and efficiency. These have regard to objectives, but they are secondary objectives. Now, I think the final question you had was with regard to the reviews, and what is being reviewed now at the Reserve Bank of New Zealand is the remit for monetary policy, which is the statement of approach to monetary policy, which sets out, for example, the 0 to 3% target. It says the CPI is the index that you shall target. You shall have regard to financial stability. You shall have regard to volatility in interest rates, output, employment, etc. It sort of fleshes out the monetary policy objective, so to speak. That's the remit, and that's what's being reviewed every 5 years with an external consultation. And they've just had, and I gave some comments, for example, a submission on that remit review recently for New Zealand. But the dual mandate is not actually up for grabs. That's not in the terms of reference of the remit review, because the dual mandate is in the legislation. It's probably getting a bit complex, but as you know, you have your basic objectives in the legislation, and then you have some of the more detail fleshed out in the remit, which is reviewed by the minister, every so many years. But you don't need to go back and change the legislation, change the remit. So for the time being, dual mandate stays in the legislation, even though there are many people who'd say, well, maybe it would be better to go back to the single price stability objective. One of the suggestions I made in the remit review was to give priority to the price stability objective, to continue to have the two objectives, but to have priority for price stability. So I'm not sure if I've answered your question, but I've tried to tackle it, and I hope that made some sense.
Yeah. I have one additional, I'm sorry, I'm coming back, just to share your experience in terms of the loan years of institutional independent central bank, and also in terms of the basically maintaining the independence in operations. Have you seen, your experience? So in your experience, say several last few decades, have you seen any attempt of the government, changing finance ministers, changing governments? Has there been any influence in terms of appointing governors, members of the board, members of the monetary policy committee, or at least under the provisions, finance minister can change the agreement with the central bank? And has that been happened, changing the finance minister agreement has been changed, or in terms of any kind of a political influence of the operation of central bank? In your experience, if you can share just to see how it practically worked in your situation. Thank you.
Yes, thanks for the question. The remit that I mentioned used to be called the Policy Targets Agreement. So in the earlier version of the legislation, in the 1989 Act, is a requirement that the minister and the governor agree to the policy targets agreement, and they'd sign it. So whenever there was a new minister or a new governor, they would do a new PTA, it was called, and then they both sign it. And so this would happen, as I say, from time to time. And, you know, the potential was for it to have some political influence, but over many years, it didn't have a lot of, you know, political meddling or anything that would really disrupt the central bank from its pursuing its price stability objective. Now, in the most recent version, where they changed in the new legislation, where they've changed to the dual mandate, they now got rid of the PTA, so it's no longer signed by the governor and the minister. It's now the remit. So the remit replaces the PTA. And the remit is more just a one-way direction from the minister to the bank saying, this is what how I expect you to operate policy. And I think that in a way is a little bit more open to political influence. And Dr. Sarath's question actually about the change that was recently put in the remit regarding house prices. And so the minister revised the remit. This is last year, because our house prices were going through the roof and causing a lot of trouble as a result of a very easy monetary policy in the COVID period. And, you know, like as in many other countries, house prices were going up rapidly as people borrowed at very cheap interest rates to buy houses. And the minister said, well, I'm going to change put in the remit, you need to have regard to house price inflation. It was a new thing, but the way the wording was in there was no actual requirement. It was purely sort of have regard to or monitor or report on house prices. And so while it appeared to the public, the minister could say to the press conference, well, look, I've asked the Reserve Bank to, you know, to be careful about house prices. In fact, it had no real requirement for the Reserve Bank to have any other regard for house prices than it had previously. So it was a bit like window dressing. That's my personal opinion, and I've actually said that in the submission that I made on the recent remit review. So you know, I say the same thing in my submission. But so that's an example where there is some, you know, some sort of political element coming through in the reviews of the remit. But by and large, I'd say it's been a fairly clean sort of process in New Zealand.
Thank you for that clarification. If I now can ask Professor Sirimal Aberatna, who is the chairman of the newly established Stakeholder Engagement Committee, which is an advisory committee to the Central Bank, whether he would like to make any comments or ask a question.
Yeah, thank you. Thank you, Professor Spencer, for the wonderful presentation and giving the experience of the New Zealand Central Bank regarding monetary policy conduct. I have a very simple question. And then a comment that would be related to the question as well. The question is what were the challenges during the first 10, 20 years that the central bank has to face, that after you initiated this 1984 reforms, the challenges. So I don't think you had the smooth sailing. And was it actually a smooth sailing during the first 10, 20 years by just looking at the dashboard and making the fine tuning here and there. Why I ask this question, because when we had also had this transition from control economy to an open economy in 1977, and today we can't explain it as an open economy. It's neither open nor closed. There are a lot of confusions around this idea, so that the most important assumption, most important lesson that we can learn from the New Zealand experience would be related to the assumption, the underlying assumptions of the conduct of the monetary policy rather than the monetary policy, because you explained nicely about the simple functions of the central bank and the limited operations confining to the central bank objective, the price stability, and the environment that you had prepared in your country, in New Zealand, enabling the central bank to conduct that monetary policy independently. And our system is, as also Dr. Sarath mentioned, is quite complicated. And the link between Treasury and the central bank, that is, or the government and the central bank, that is quite complicated issue here. And also the governance issue, that is quite complicated here, because we never know what is changing tomorrow. I'm actually, to give you an example, I'm heading a Industrial Policy Formulation Committee for 3 years now. It was supposed to be 1 year. And I was briefing to 4 ministers so far. And I also have to brief tomorrow to the 5th secretary who came recently. What is it all about? So there is no consistency, there is no predictability in this system. So we are operating in an entirely different environment. So that's why I said the underlying assumptions are the most important lessons that we can learn for Sri Lanka. Secondly, I also like to mention about the, when I draw the parallels between New Zealand system and the Sri Lankan system, I think there has been no country which have escaped from any kind of crisis, so that there have been budget deficit, current account deficit, and so on. But the crisis that Sri Lanka right now in is much more than that, that kind of normal disturbances to the macroeconomy. And in that crisis, as Governor also mentioned, that of course central bank has an important role to play, conducting the monetary policy and also conducting the taking care of the government debt. But at the same time, I also understand this, in this crisis, the central bank role is very limited, because it's a structural issue in the country where we haven't done enough to generate enough foreign exchange. So it is basically a structural problem which is outside the central bank operation, but central bank has been involving in this problem as a major institution responsible for the problem. So this complicated system, conducting a simple monetary policy operations is quite a challenge. I think that's why I asked you the question that how smooth it was sailing during the first 10-20 years when you changed the monetary policy. Thank you so much for your presentation and for your comments actually regarding all these questions, and I learned quite a lot, and I also learned from your presentation about the wonderful experience, wonderful achievements that the New Zealand has done during the first 10-20 years. Thanks.
Thanks for those comments, and I certainly appreciate that Sri Lanka has a very different situation today to what New Zealand faced in the early 80s. There are obviously some common elements, some issues that sort of look similar, But, you know, I don't pretend to say that this is some identical situation, and you have a complex, multifaceted issues to deal with and to get on top of. And, you know, the monetary reforms, I think, are important. I think they're an important piece in the jigsaw puzzle. And as the governor said, I think it's clear, and I looked at the new monetary bill. I didn't, not in great detail, but it looked pretty sensible to me. And so, you know, sometimes you want to go, you know the direction to go in. It's a matter of getting implementation and making the whole thing work in the political and economic environment of your own country. In terms of the experience we had, you know, in the first 10, 20 years, it was certainly not plain sailing. There was a lot of volatility and shocks along the way. I think overall it has been quite successful in the sense that low inflation was achieved in the early 90s following the reforms period that I discussed. Inflation really stayed close within the target range, moving occasionally outside of the target range, but that's acceptable under flexible inflation targeting. And that's been the case right through to the present day. And it's only that, you know, in the last few quarters where inflation has really got a bit out of control due to very easy policies in 2020-21 combined with the oil shock and the COVID shock. And it's only very recently that inflation has sort of got a bit out of control and inconsistent with the central bank's objectives. But I would just say that some of the difficulties along the way have involved going back to the times when there's been very large fiscal deficits have been a real problem, and that was raised earlier with the question about the fiscal situation, and also often with regard to the international trend of interest rates. So if New Zealand's trying to tighten policy, as was the case, for example, in the period prior to the GFC, and if the rest of the world's interest rates are staying very easy, in other words, if the local and the external monetary policies are out of sync, then that can cause problems. And in particular can cause a lot of pressure on the exchange rate in the floating exchange rate environment. And so when there are these distortions, whether it's either the fiscal issue or an external issue, then that can make it a much more difficult challenge to keep on track with monetary policy. But that's, you know, that's part of the game, and it's very rare that it's totally smooth sailing. So in that sense, Sri Lanka is not alone.
I also happen to be the economic advisor to the president. So I'm seeing this every day. It's not going to be easy, but we have to do it. But I've seen countries, other parts of the world, from my last incarnation, many other countries were in terrible situation, were able to come up. Needed a good leader, needed the population to understand what was at stake, and needed some outside help as we need, and they came through. I've seen countries like Ethiopia going from starvation and complete fall in society to come up again. Of course, now they are back at it again, unfortunately. But many countries have done that.
Yeah. Oh, no doubt. And all I'm saying is that
if I can now turn to the central bank, anybody? Yes, go ahead.
Thank you, Deputy Governor Spencer, for very nice session on experience sharing and very educative. My question is simple, and it is related to your reference to central bank budget being approved by the minister. And I'd like to ask you whether it includes the monetary policy implementation costs and the other costs like currency issuances, or it's only the administrative costs that you're referring, because we know central bank's expenses, majority is not the administrative expenses. Majority of the monetary policy implementation costs, like sterilization. Thank you.
Yes, the 5-year funding agreements, which are effectively the central bank's budget, was for administrative costs. In implementing its monetary policy function, its financial stability function, and its currency function. But not all of the currency costs, of the currency manufactured costs, I think were sort of separate from the budget. It was basically, yeah, operating expenditure that was covered by the budget. So then at the end of the year, the bank would see how much money it had made from its balance sheet. And typically, because of the structure of its balance sheet and the seniorage that it was earning on the currency issue, it would earn roughly 300 million New Zealand dollars per annum. And then it would take the budget amount that had been allocated and approved by the minister would be taken out of that, and then there'd be a sum to retained earnings to maintain economic capital within the bank, and then the remainder was paid to the government as a dividend. So there was, so as I say, this budgeting process would basically influence how much of the bank's profit it could keep at the end of the year to meet its operating expenses. And that was held under the control of the minister. Does that answer your question?
Thank you.
Before we come to this side of the room, anybody else from the central bank staff? Yes, Director Economic Research, go ahead.
Thank you, Professor, very much for very interesting.
Can you lift the mic?
Yeah. Thank you, Deputy Governor, former Deputy Governor, very much for a very insightful presentation. My question is basically in terms of sequencing that you mentioned. So I'm share some experience in Sri Lanka. So what we have done is we have imposed some stricter fiscal management measures far back in 2003 by introducing the Fiscal Management Responsibility Act before we introduced the central bank legislations, reforms. But what we saw was like since the introduction, we've been postponing those targets every year. And but on the inflation front, we've been able to manage inflation within the 5% range, as Governor mentioned. So the question to you is it really the legislations that we are talking of, or really the people who hold in the positions and the credibility and the commitment to achieve the objectives? Thank you.
Well, I can't comment on the specifics of Sri Lanka, but in a general sense, if you're saying, well, you need to get the fiscal deficit under control in order to have an effective monetary policy, that as we discussed earlier, it's not a necessary condition. It just makes it harder. And so if you can't get the Fiscal Responsibility Act through, or if fiscal policy is still not under control, I think the central bank should still be trying to achieve its objective, and it can still achieve its objective, but it will put more pressure on interest rates clearly than it would if fiscal policy was under control. And so the fact that that puts in pressure on interest rates, then that becomes more of a pressure on the government to get the fiscal house in order. And that's why, you know, you can't just stand off all the reforms waiting for everything to happen in the right sequence. You've got to get on and do the best you can and take a practical approach. And the more you succeed in one area, it creates pressure to succeed in another area.
Anushka, over to you.
Thank you, Murtaza. Professor Spencer, two quick questions. The first is, if both questions are at opposite ends of the spectrum, if you will. The first is very micro and internal to the Reserve Bank of New Zealand. If you could cast your mind back to the period in which those reforms were initiated and reflect on the new technical capabilities that needed to be built up as the central bank shifted the way in which it worked, whether it was, you know, new teams, units, or skills that you recall needing to be developed at the time in order to deal with the new avatar of the central bank and the new kind of technical demands required of the new monetary policy approach. The second one is at a much more macro level and perhaps links a little bit to what the High Commissioner talked about. In your segment on sequencing of reforms, you said that the monetary reforms gave impetus to the broader reform endeavor. Could you add a little more color to that? And particularly, you know, Murtaza at the start talked about the All Blacks. You know, a rugby team is only as good as how the team works well. So if you were to imagine the central bank as one of other actors in economic governance of the economy, what was the relationship between this new reformed central bank and the other institutions, and also loose parallel to the spectators in that rugby match, the public? How were there any deliberate measures to get the public to understand the new remit and the new avatar of this central bank, the reasons for these reforms, so that it is anchored and isn't susceptible to shifts as political parties come in and campaign on various matters? So first question on internal, what are kind of the new technical competencies, and the other is public buy-in. Thank you.
Maybe just tackling the last one first, the public buy-in, because you know that is crucial to get the public buy-in, to get the political support. And you know, the thing in common, I think, is a crisis. If you have a crisis and you run out of money, then that can create the impetus to say, well, we have no alternative. We have to act. We have to reform. We have to do something different. This last approach we've had is not working. And that's what happened in 1984 in New Zealand. And so because of the huge disruption and the crisis, and everyone saw this in the newspapers every day, then the public bought the story, and they rightly bought the story that policies had to change. And so that's why, you know, a crisis creates that opportunity, but it has to be, it has to be sort of sold properly, and it has to have a leader, a political leader, not just a public sector leader, to say, this is, we have no alternative, this is the direction we have to take. And in New Zealand's case, as Michael said, you know, there was David Lange, the Prime Minister, and Roger Douglas, the new Minister of Finance, that was leading the charge and saying, yeah, we have to make these reforms, put them in place. So yeah, the communications is crucial. Now, coming back to your first one on the technical capabilities, with the bank, the key areas to move to a sort of market-based monetary policy. We had to, after deregulating the financial system, we had to build and develop money markets and markets for operating to achieving control over short-term interest rates. So there was quite a rapid sort of move to establish a sort of a financial markets team or enhance the existing financial markets team, and to establish financial instruments that could be used in the market for open market operations to affect settlement cash, to affect short-term interest rates. That all required new skills, new systems, etc. But you muddle your way through. Nothing's perfect on the first day. Sometimes you just got to jump in the water and then you find that you can swim. And as time goes on, you swim better. The other area I'm thinking of in terms of skills was, of course, in the actual forecasting of the economy and trying to say, okay, if we have this price stability target, then what's the actual transition? What's the link back through the economic variables back to the policy instrument? And, we had economic models that we'd been developing for a number of years, and those needed to improve. But again, you can never get perfection in your econometric model, but there was quite a bit of effort put in on that side of things as well. The other aspect was the All Blacks team approach, and the message has to be that all the members of the team have to pull together. But of course, they don't all pull together. They don't all pull together at the same time. And at the end of the day, the government has to take the lead and push things through where they can, take a practical approach. And that will create pressures elsewhere, which will cause pain. That pain will be an incentive to create further reform, for example, in the labour market or in the trade or external side of things, or in agriculture. And that's just how it worked in terms of observing that the way that things were implemented. Because you can't always think of everything up front. You don't have a grand plan to start with saying, this is my wiring diagram and Gantt chart for the whole project. It just doesn't exist. You have to work and be quick on your feet and respond to the pressures when they come up, and try and push through those reforms and changes when it becomes clear that they are imperatives.
Thank you. I think Deshal Dimel has a question.
Thank you, Murtaza. Thank you for the presentation. So you made reference to the fact that in the New Zealand process there was the removal of Treasury officials from the Monetary Board. In Sri Lanka's monetary reform process, one of the debates has been that in the event of the removal of the Treasury Secretary, in this case from the Monetary Policy Board, what would be the operational mechanism for coordination between fiscal and monetary policy? So were there any kind of institutional mechanisms that were built into the New Zealand process that enabled this more kind of operational coordination? If you could maybe touch on that. And secondly, again, one of the arguments of having some flexibility from a rules-based monetary policy during a crisis, and we saw that during the COVID experience, many countries did shift away from conventional monetary policy during that kind of extraordinary situation. Again, were there any kind of legislative or institutional processes or structures that enabled that kind of flexibility on a temporary basis to kind of tide through a tighter crisis, and then ways in which you come back to the mean during a particular time frame? Thanks.
Well, thanks for that question. on the first one, the Secretary of Treasury was removed from the board and from monetary policy decision making, but there is still a Treasury representative as an observer who like sits in the corner or on the edge of the desk, the table, in Monetary Policy Committee to observe what's happening and in theory to answer questions about, or how would this action affect fiscal policy, for example. Now, the person is the Secretary of the Treasury, but will typically be represented by, an Assistant Secretary or someone a bit further down the chain. But the reality is that that person gives a one-way feedback to Treasury about what the bank's doing. But my understanding is there's very little two-way discussion about, in MPC, about how this might be a sort of a fiscal monetary coordination issue. So what really happens, there's still good communication obviously between Treasury and the bank, but the Treasury lets the bank know exactly what its fiscal projections are for the deficit, for its debt program, and then that information is built into the bank's forecasts, and therefore it is built into its decision making, a decision on monetary policy. And then, 3 months down the track, there'll be more different, the fiscal information will change, and so that will again feed into Reserve Bank's models and decision-making process. So it's there's not an explicit coordination because, the Reserve Bank has its objective, which is price stability, and the Treasury and the government on the fiscal policy has a more medium-term objective. It does not have a counter-cyclical stabilization type objective. Now, it did have many years ago, and we talked about in the early 80s and the 70s, then fiscal policy did try to be counter-cyclical and smooth the economy, but they always got it wrong, and they got the timing wrong and made mistakes. So that's why in the reforms, the change in approach of fiscal was to be much more medium-term focus, to say, what do we need to supply the infrastructure for the economy, the education requirements, the health requirements, and move steadily to achieve those objectives rather than trying to fine-tune the economy through cyclical actions. So in a general sense, the fiscal information is a medium-term focus and a stable background. But that information, where changes do occur, will feed into the monetary policy process. Now, you mentioned the recent COVID exercise, and of course, that was a case where there was more of a coordination between fiscal policy and monetary policy in New Zealand and in many other countries. But even though the central bank moved to unconventional monetary policies and adopted quantitative easing, buying all these government bonds, which made the government's running of a large fiscal deficit much easier because they could sell the bonds over the road to the central bank. In principle, and I believe in fact in the New Zealand case, the central bank still made the decision about how many bonds to buy. So the quantitative easing decision and the bond purchases were still at the discretion of the bank. Now, I don't know what was going on behind the scenes of private meetings between the minister and the governor over the last couple of years, but I mean, you're right that I think in New Zealand and in other countries that sort of independence of the central bank was somewhat tested. it was tested because the governments were spending a lot of money on wage subsidies, on trying to maintain incomes while everyone was staying at home under these various lockdowns. And so there was that apparent coordinated approach. But the test of whether the central bank independence has survived is now being run in that test, because we're now seeing that with inflation, the central bank has to come out and get on top of it. The central banks are stopping their QE programs and having to actually reverse the programs and sell those bonds back or let them run off. That's what's happening in New Zealand. And some other countries, I think it may be more difficult. But you're right, it's been a test of whether a central bank can really stick to its guns and stick to its price stability objective.
Thank you. On the central bank side, anybody has a question? What about the others? Yes.
Yeah. Dr. Spencer just said, I want to know, I know New Zealand has a very active parliamentary system, committee system, and which a lot of interaction. In fact, before a bill comes into Parliament, the parliamentary committees themselves have a lot of interaction. As a result, there's not much amendment on the floor or opposition. It's almost unanimous. Does the parliamentary select, what is the interaction of the central bank with the parliamentary select committee, and how that interaction fed into building up confidence in the public of the reform process? And I know that the ghost of sort of 84 pushed a lot of things in New Zealand, and so whether that sort of and thereafter what's in interaction with the central, which Parliament has helped them to bring about reform and that sort of.
Yeah, an interesting question. I mean, I agree that the current situation in New Zealand, the parliamentary committees are active and have played important roles in modifying, adapting legislation, and where both parties are sort of operating in the committee and having an influence. And just in terms of the central bank, the Reserve Bank's accountability to Parliament, they have to front up to the Finance and Expenditure Committee after every policy statement. So in the next day or two after the policy statement, they go over to Parliament, and the subject and the governor and deputy governor, etc., are subject to the questions from that Finance and Expenditure Committee. So, and the press is there, so it's an open meeting. So, you get that element of public accountability as well. So I think it's a useful forum, and it has produced a certain amount of fireworks in recent times. But in terms of the initial reforms in the 80s, I would have to say that through that period, the Parliament did not have a huge influence on the new legislation that was really coming out in a very frequent fashion from the government. And it was really coming through cabinet. Cabinet was the driving force, and even they say within that was the mini cabinet of sort of a handful of key ministers who were really thrashing out and driving determining the shape of new legislation as it came out. and there was quite a bit of, you know, consternation in Parliament from the opposition that Parliament was not really playing a big role in that initial reform period. But you know, but as I say, in more recent times, Parliament and the select committees have been playing a bigger role.
Ilan?
Can I ask a non-central banking question? Sri Lanka has had a paucity of making evidence-based policies. However, in the central bank, we have a very strong research department. In the finance ministry, we have what's called the national planning department, who's been sort of relegated to a level of impotence. What's the experience in New Zealand in terms of mobilizing the strong knowledge base of the likes of a research department of a central bank or a planning department of a finance ministry in driving evidence-based policy making?
Wow, well, that's, yeah. I think, you know, that you've observed correctly that, you know, different groups of within the public sector can play different roles and have different degrees of power, you know, through time, and so the power of some groups, whether it's a planning agency or the Treasury or the Reserve Bank, can wax and wane, you know, through different periods, often depending on the actual individuals involved in terms of the governor and the Minister of Finance, the Minister of Commerce, yeah, other ministers as well. So in the case of the 80s, 90s reforms, the big driving forces in terms of shaping policy was mainly the Treasury, the New Zealand Treasury. And, you know, there were other sort of economic and research functions around other parts of government. But in terms of that reform process, at that point in time, Treasury was had a very strong influence. The Reserve Bank had a strong influence as well, but mainly around the monetary and financial sector reforms, the floating of the currency, etc. So we were deeply involved in those aspects. But if you're talking about the broader economic reforms, Treasury was where it was coming from. But you know, in years since, like right now, today, Treasury is a much weaker force in New Zealand policy making. So these things change through time, and often they're a function of personalities. But as you say, you would hope that they're evidence-based, and I think when they're successful, they're evidence-based, but it's not always the case.
So we are ahead of time. I normally dominate questioning, so I kept some reserve questions. So Professor Spencer, New Zealand Central Bank, can you comment about your HR system, whether you allow talent to move to horizontal positions, or is it about that you have to move vertically up in the organization?
It's certainly horizontal movement does happen and is encouraged, and even in my own career at the Reserve Bank, I started in the Reserve Bank of New Zealand as an econometric modeler in the sort of late 70s, and it was the big thing to build econometric models. And I had a sort of maths and economics degree, so that's where I started. But then subsequently, I moved into economic policy, and then into financial markets, and then eventually into banking regulation and supervision. And in fact, I'd moved outside the organisation, been to the IMF, and also worked at a commercial bank, at the ANZ Bank. in Australia. So I guess I typified quite a significant degree of horizontal movement, and I was trying to achieve as much vertical movement as I could, but that didn't always happen. So yes, it's a flexible entity. Whether it's still that flexible today, I mean, generally the Reserve Bank, when it has say a management position to fill, would be looking for someone else in the bank, either in that area or from another area or outside the bank. So often there'll be an internal and an external candidate for a role. And at least in recent times, where the bank has been expanding, because under this government, the bank's budget has expanded, there's been quite a lot of external hiring. And I'm not sure about that may have dominated the internal horizontal movement. But that's the history, is certainly, that's the tradition, is a lot of horizontal movement.
My next question is about asset price inflation. Now, in inflation targeting, my understanding is it's mainly on goods and services. Of course, there's an imputed figure for rent in the inflation calculation. But all over the world, we have had very, very high asset price inflation. Can you did mention to Roshan's question about housing prices. Can you weigh in on asset price inflation and how it is brought into a central bank's inflation targeting framework?
That's a very good question, and it's one that you know, where there's quite a different approaches between the central banks, and under the initial framework of our inflation targeting regime, or flexible inflation targeting, it was the primary objective of price stability, have regard to output, employment, etc., and have regard to the efficiency and stability of the financial system. So asset prices or asset price volatility could be brought into that secondary objective. So often, this is the case in New Zealand and in a number of other central banks, there'll be a secondary objective, have regard to financial stability, which allows the governor to indeed have regard to asset price inflation. So if the house prices are going up by 30% and saying we really need to have regard to this and maybe not have our foot on the accelerator so hard for monetary policy to avoid the damage that's happening from asset price escalation. But if you talk to some central banks, and if you talk to the Federal Reserve, for example, in Washington, they will say that financial stability and asset prices has no real role in monetary policy, because they have price stability and maximum sustainable employment, and for asset prices and financial variables, you use other tools such as financial regulation. So I think my view is that asset prices are a very important factor to look at when making monetary policy decisions. But what I'm saying is that that doesn't always apply across other central banks. And indeed, it can change through time, depending on the governor and their approach to this question. Does that answer your question?
Yeah, Murtaza, please, yes. Something related to that question I have on the New Zealand Act, what we are looking at on the financial stability, macroprudential policy, and the microprudential. Basically, in our law, earlier central banking law, we have this regulation and supervision authority, and also we used to, under same wing, we have been using macroprudential instruments to address all these overall macro prudential issues. So the in the new law, what we are proposing is to have a separate kind of a recognized macroprudential supervision authority in the new law, and which will have a different role to microprudential regulation and supervision of the individual banks and non-bank institutions. That is, just like to know what kind of, I guess the macroprudential asset price bubbles also is something that we need to consider under macroprudential authority or supervision rules and regulations. That I'd like to have your comments. What is your structure there? Thank you.
Well, indeed, that's the case. So the advent of macroprudential policy, which was been brought in by many central banks, after the GFC. So around, in New Zealand, we brought our first macroprudential in like 2013, was very much to try and help give assistance to monetary policy. Because after the GFC, interest rates were very low and they stayed low. And so that tended to promote asset price escalation. But because CPI inflation was staying very low, there was no scope to tighten monetary policy to try and offset some of that asset price inflation. And so hence a lot of central banks, including the Reserve Bank of New Zealand, brought in new macroprudential tools, and ours were the LTV, loan to value ratios. And they were some assistance, and they certainly reduced risk in the banking system related to the housing cycle. And to some extent, they helped to moderate house price inflation as well. But they didn't have a systematic effect. They, sometimes they sort of work well, sometimes not. And my general observation would be that, they do assist, and they're a worthwhile policy to pursue. But monetary policy has much more influence and leverage over asset prices than macroprudential ever will. So they're not of equal power, so to speak. And so in my view, monetary policy still needs to have regard to asset price inflation. They can't just say, oh, that's not our problem. Macroprudential will look after that problem. So to me, that is a bit of a false recognition or a false degree of power attached to macroprudential, because macroprudential can only do so much, and its main job is to reduce risk from asset cycles in the banking system. But if you're lucky, it might also help to moderate asset price cycles. So so my view is that monetary policy still needs to have regard to house price inflation, asset price inflation more generally.
Thank you. You're almost out of time. I have one last question, Professor Spencer, which I think even High Commissioner Appleton also can weigh in on this. There is some very distressing news coming from your country that your All Blacks are losing. What's going on?
Well, yes, I think it may be a problem we're not playing as a team, as was earlier observed. And so we've lost, I think, 5 out of the last 6 matches. So this idea of being the top team in the world is wearing a little bit thin, and it's causing a lot of distress here in New Zealand. And it's one thing I'm not sure monetary policy can do anything about.
Well, I just want to add to that I think the All Blacks losing is like the worst thing that can happen to New Zealand psychologically as a country, and it's been happening a lot recently. So we need it to stop, and hopefully Grant can come up with some ideas for how we can fix that. But in the meantime, when Sri Lankans come and talk to me about the All Blacks and their love of it, I'll pretend like I don't know that they've been losing recently.
Thank you very much for all of that. We have come to the end of today's session. Thank you very much, Professor Spencer, for having spent the time with us and educated us. Thank you, Governor Weerasinghe, for having made this session possible. The Advocata Institute, as the word Advocata means, it's about advocating. And our real target audience is young people between the ages of 16 and 35. We hope that today's content, which is a little bit technical, certainly can be taken across and shared with a much wider audience through social media, etc., so that there is a know-how transfer and there is a more intelligent debate that happens in our country. We have some refreshments for you. It's on the 16th floor, which is one floor up. It's called the Loft. Please join us for tea.
Thank you. It's been a pleasure participating.
Thanks, Grant.
Thank you.